Kia ora, welcome to Shared Lunch, brought to you by Sharesies in association with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Dan Brunskill. I'm the markets reporter at BusinessDesk. We have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch100, you'll get $100 off an annual subscription to BusinessDesk, which is usually $249 including GST. The offer only applies to new BusinessDesk subscribers and can only be used once per subscriber and can't be used with any other discounts. Before we jump into the podcast, here's some important information from Sharesies.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Okay, and always just remember, if you have any questions for our guest, you can submit them through the Ask a Question button, which you'll find down below. Don't ask your questions in the discussion or the chat area, as I'm not looking there, just in the Ask a Question area. Please be kind and respectful towards our guest and towards your fellow viewers, otherwise we will take steps to remove you from the webinar. Today, our guest is Greg Fleming. He's the head of Global Diversified Funds at Salt Funds Management. We're going to be talking about bear markets. Last week, the S&P 500 slipped 21% to officially enter bear market territory. So we're going to talk through what is a bear market, what makes this one different, what are the opportunities / risks, and what does it mean for you as someone who invests, and we'll discuss all of that. So welcome, Greg.
Thanks very much, Dan. It's good to be here. Hello, everyone.
Pleasure to have you. So let's just start with the real basics. What is a bear market, and why do we call it that?
Okay, bear markets are rarer than bull markets. If you go to Wall Street, you see a statue of a bull, and it's got its horns pointing to the heavens, and that's to show that it's basically tossing prices upward. Bears, by the other hand, have claws and they tow prices downwards. So this has become a kind of shorthand for saying a longer than 1 week or 2 weeks downward trend in prices that then bring about a 20% fall in the index you're looking at.
Okay. So bears bring things down, and I guess the key part there is that it's a prolonged period. It's not.
Yes.
Yeah, not every fall is a bear market. My brother was asking this question, why is it called a bear market? And I didn't know at the time. And his best guess was it's because bears eat everything. It's like they find a pot of honey and they eat it all up and your portfolio goes down. I thought that was...
It's a good answer. I don't know who might have seen the film The Revenant, but it's a great film. There's a bear in that, and that's pretty much what bears behave like in the market too. They come running at you when least expected, and then they completely savage you, and then you kind of get yourself together over the subsequent months.
So I think probably a lot of people relate to that, looking at their portfolios and their KiwiSaver. So how did we get into this bear market? What's driving it? Can you explain that in succinct terms?
Yeah, I think best to step back to last year's bull market, 2021. Exceptionally strong year. Just to talk about, say, the S&P 500 in the US, it logged a 30% year, which is 3 times the long-run average year for that S&P 500. It was a rebound in 2021 from 2020. When we had the COVID response from the world's central banks and from the world's governments, you had a kind of double barrel stimulus program that went on for a long time. So you had money given away through the fiscal side of the equation, that's government spending, special payments, checks in the mail in the US, rounds of actual cash coming from the government, signed by the Treasury Secretary, that you could cash and go and spend. On the other hand, you had your interest rates pushed to zero in order to just keep sort of activity alive right through COVID. That kind of led to a buy everything mentality. Whenever you expand the money supply, a good deal of it will leak into assets. So you had property rallying, and then you had listed assets rallying even harder than property. That gave us this very, very strong 2021. When you get a massive positive return year like that, if you're a fundamental analyst, as we are, and as I have always been in my career, you start worrying about valuations. And by the end of last year, you had some exceptionally expensive sectors, in the equity markets around the world, and individual companies as well. So it was kind of sitting in a balloon situation, waiting for the catalyst that would pop that balloon. This year, that catalyst came, and it came because inflation, which had been predicted to fall away quite quickly by those central banks, didn't fall away. And inflation is still persisting, well above 8% in most developed countries, above 10 in some. Central banks are panicking now, raising interest rates to bring inflation back into check.
Interesting. So a big part of this decline is that asset prices were really high during 2020, 21, and they're coming back actually like near to a more normal level.
Yes, I mean, we got to, I don't want to get too technical, but on those price earnings ratio measures and all those measures like that, record highs, price to sales is another measure people use, also at record highs at the end of last year. In many cases, people were getting into the mindset of not even needing positive current earnings, being prepared to look out 5-10 years for the and still paying premiums for the stocks in question. So yes, those valuation things don't matter until they do matter, and they start to matter when the discount rate goes up, discount rate being set by the longer term bond yields. And then the earnings brought back into the present day look a lot less impressive.
So that's just interest rates are used to value stocks. When interest rates go up, the value of stocks come down, even if things haven't changed that much for those stocks.
Yeah, because a stock is a claim on the cash flows of the company, and if the cash flows are in the future, then you have to have a rate to value those cash flows at, net present value, all that kind of technology.
So if that's what's driving investors to sell, because that's why prices are going down, right? Investors are selling their stocks. Where do they then go with that money? What happens to that money when they sell? Where are investors going?
Well, this is one of those relatively rare in recent years phases when cash is king, you know. I mean, until this year, cash is trash was kind of the phrase that was being bandied around, because staying in cash was just keeping you, there's a lot of FOMO, and you were being, losing opportunities on all kinds of fronts. But now, of course, cash is king. So people are just liquidating portfolios. It's a sort of technical word for turning them back into cash holdings. And so cash levels are rising. People are keeping that powder dry, waiting for signs of a bottom in order to go back in and start reinvesting. So some are more bearish than others, and the ones that are more bearish than others are probably trying to buy store of value kind of assets that they think will hold up through recessions. Others are quite happy to rotate into the safer sectors of the equity markets.
Okay, interesting. And if they're holding cash, waiting for the bottom, when will that be? How will we know? How long do bear markets normally last?
Yeah, this is a really interesting question, Dan. I mean, all we have to go on with that is history. And so if we go back to the crash of 1929 and we include that crash, so that's almost a century ago, 92 years ago, there have been 26 bear markets in that time since 1929. And so we get some statistics out of that data, which are very, very useful, because we can work out average duration, average time of the bear market, and average damage of the bear market, along with other metrics. I'm sorry to say I'm old and grey enough to have sat through 6 of those 26 bear markets in the course of my career since 1997, the first being the Asia crisis and then the Russian default crisis in 98, hard on the heels of the Asia crisis. The average duration of a bear market is around 9 months, 9.5 months. So it's much shorter than the bull market. The bull market average is actually about 2.7 years. So let's say 2.5 years. What we've had recently is longer bull markets and shorter bear markets, but that's been because the bear markets have been rescued by the monetary authorities. So let's say 9 months, and let's also say that the bear market started, we can say that now, in early January, because that was the peak of the bull. So we're already 6 months into a 9-month average bear market. This one may run a little longer, but it may also be in its closing months.
Yeah. Okay, interesting. So the average is 9 months, and we're 6 months into this one. So if it could run longer, of course. But interesting. Okay, all right. And do you have a view on whether this one is likely to be a longer lived or a worse one than some others?
It depends on inflation. I think
Okay.
that's the short answer.
Yeah.
I think if inflation is showing signs of topping out, as it seems to be showing some very early signs. I mean, it's certainly roared up very quickly,
Yeah.
and that is showing all kinds of causes. Energy prices have been a key cause of that. We're just starting to see really early signs of energy prices may have topped.
Okay.
And that's actually a good sign, because that means if energy prices top, you don't get those second round effects where people add the cost of transportation onto their goods prices and everything goes up through the roof at the supermarket. Having said that, we've also got market valuations restored to more reasonable levels. People are saying now that the ratios I talked about earlier are back in line with historical averages, having got overcooked at the end of last year. So it's been a swift and severe restoration of a credible valuation level. Things overshoot in capital markets. They don't just go back to fair value and stop there. It would be nice if they did. They can overshoot to the downside. But I think what we've seen downside overshoots in the things that had overshoots to the upside during the bull market.
Yeah.
So the things that did really, really, really well in the bull market, sectors and stock-wise, have suffered worse in the bear market.
Yeah, that's really interesting to me, because I sort of covered markets throughout this time, and I would talk to people like you and fund managers all of the time who would say asset prices are sort of high/inflated because of central bank policy, because of the amount of stimulus, and it always seemed like people knew things were overvalued, and there was sort of an awareness that things were overvalued, and yet this sort of correction, this fall back to average, seems to have come somewhat as a surprise. What do you think is driving that? Is it just that people didn't expect inflation to appear? Or, if people knew assets were overvalued, why is this such a surprise, and why did the markets let it happen?
Yep, I think that's a very good question. I mean, the experience of investors in the last 30 years, really, since, say, 1990, that recession, has been that things get overvalued, but they can stay overvalued for a very, very long time.
Okay.
And managers who just look at valuations alone have had to explain to their investors why they've lagged the markets, because they've ended up being too cautious.
Yeah.
They've stayed uninvested, they've had excessively high cash holdings, and they get into a psychology of just desperately hoping for a crash so they can justify the fact that they haven't been invested through a bull trend. So that builds a bias into managers to be invested whenever they're confident that there will be upside. But that has been set in the context of a low interest rate and declining interest rate regime engineered by the central banks for various reasons. It started with the global financial crisis, when the banks and the governments worked out that by suppressing interest rates or repressing interest rates, you can actually get a shortcut out of a recession, or you can dodge recessions that would have been deeper and maybe have turned into depressions. But that became a kind of habit, and they started using it to manage the cycle, perhaps where it should have maybe only been kept for emergency situations only.
Okay. Yeah. Interesting. And we talked before about how the bear market might start to come to an end when inflation peaks and investors have more confidence that interest rates won't keep having to go up. But of course, there's kind of a twin risk that when inflation peaks, it will be because the Reserve Bank is raising interest rates and slowing the economy. If we enter a recession, even a small one, is that likely to extend the bear market? Is that likely to stop any sort of bounce back?
It's really interesting, because the traditional wisdom was that monetary policy from the central banks has a lead time of at least a year and up to 2 years, maybe. So the policy shifts that a central bank is making would be expected to have their maximum bite in about 18 months' time in the future.
Yeah.
But what's happened recently is almost real-time monetary policy adjustment. So cuts are expected to rush through into the economy and stimulate demand the very next day, or hikes are meant to rush through and repress activity the very next day. That's not the reality. People take a long time to adjust their patterns of behavior. But markets go well in advance of the underlying economy. They're so forward-looking. Markets are pricing developments already in 2023, in 2024, and they're pricing the risk that there'll be a monetary policy mistake, either from the Reserve Bank here or the Federal Reserve, and that will cause a deeper recession than we're anticipating.
Yeah. Okay. So part of the decline we're seeing now is market concerns that there could be a recession next year.
Yep. It's building in a risk premium. It's kind of overshooting to allow for the risk that a recession will be deeper or will even happen at all. I mean, there's no consensus as yet that there will be a recession as a response to this tightening up of monetary conditions.
Okay, interesting. Just a reminder to our listeners, chuck your questions in the question. We'll get to them relatively soon. I think one question that a lot of listeners may have is they might be looking at their investment portfolio and it might be showing a really big loss, and they might be asking themselves, well, what do I do? And I know we don't want to get into sort of specific investment advice, but I mean, as a portfolio manager yourself, what are some options if you are sitting on a big loss?
Yes, I was thinking about how to answer this kind of concern, because this is obviously people's first question in any discussion. And I thought, well, the best thing to say is, look, if you as an investor liked a security during the bull phase, your view of it shouldn't change during a bear phase. Your view of that security should relate to that company, whether you believe in its business model, whether you believe it's got growth potential over a multi-year time frame. If you bought it when it was going up, that was sort of nice, that's a nice to have, but that shouldn't condition your view of the quality of the investment. Prices will fluctuate a lot. And now on the converse, if the price of an investment is going down, reassess your commitment to their business model, make sure it's still plausible, but don't abandon a security that you liked last year just because the price of it has dropped. In many ways, it almost argues to think about having a little more of that security.
Okay, interesting. So it's almost like you're saying, don't think so much about what the price is doing. Think about what the business is doing.
Yep.
And if you think the business is going to do well, then you're probably okay to hold or even to buy more.
100%.
But if you bought something just because its price is going up, maybe then it might. Okay.
It's why you're investing, and whether that's crossed at any point into trading, because that's at the difference. You're trading if you're buying a security whose price is going up largely because it's going up. If it's fine, people are happy to do that, and there are some very successful traders. If you want to invest rather than trade, you should be a bit more agnostic about the price of the security. And if it's come a little cheaper, you'd sort of rejoice rather than despair. And look at that, at sort of averaging into that security over time.
Do you have some sectors or sort of types of assets that you think are particularly likely to perform well during a bear market or indeed during a recession?
There are definitely sectors that have historically proven that they do that. They get called the defensives for that obvious reason. It's hardly a creative term. They are ones that really have solid underlying demand from consumers, and sometimes it's not that demand doesn't go away just because the consumers are spending less or are tightening their belts. In that, you can look at consumer staples. Consumer staples, it's the Eurofins of this world. It's the brands that people buy regardless of where the economic cycle is. And there are a wide range of them. They can be food producers. They can also be medicines. They're generally the things that people don't cut back on. So any consumer staple exposure is really, I won't say recession-proof, but you get the term recession-proof bandied around. And indeed, no surprise, that's been one of the most resilient sectors. Also, utilities and infrastructure is an excellent sector through both a bear market and a recession. All of those, and we're in New Zealand are lucky because we've got a rich choice of infrastructure providers listed on the local market. Those earnings from infrastructure providers are pretty solid and largely assured. I mean, they can fluctuate over the short term, but that's often to do with things about electricity generation or government policy can influence the earnings of those companies. But as a medium-term holding, so anything longer than 3 years, they are actually quite good. And in times of great booms, they look rather sleepy, those companies. And people say, "Oh, what a dreary, boring company that is." But those are the ones to hold through both bear and recession periods. And the other ones to hold, which are a bit more growth-oriented but still defensive, are the ones with pricing power. So if you can identify a company that can raise its prices along with inflation and make that price increase stick, that's definitely a place to go, because people will still consume certain things regardless of the economic environment. And I think people's spending habits have changed over the last decade.
Yeah.
They spend a lot more on services and on online delivery, things like that. And if their habits have formed, they're unlikely to cut back just because their wallet might be a little bit less fat. They'll keep those services up and maybe cut back in some other part of their expenditure.
Yeah, interesting. So discretionary spending might come down, but
Yeah.
if you have a really desirable product and you can push through price increases, your business might do well.
Yeah, that's what they technically used to talk about as wide moat businesses.
Yeah.
You can make your price increases stick because there's no competition who can undercut you.
Yeah.
If you can identify those firms, they tend to do well through bear markets and
Yeah.
even through recessions.
Recession resistant, perhaps, if not recession proof.
Yeah.
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 Yeah, that's sort of an interesting thing. Is sort of I speak to a few fund managers during this time, and a couple of them have said, like what we're trying to do right now is not necessarily make money. We're trying to lose the least money we can, so that when opportunities come up, we can sort of buy into them. How are you thinking about it in this time in terms of what your portfolio is doing? Could you talk us through, perhaps, I don't know if you want to go into this detail, but if you could talk us through what you did in 2021 at sort of when asset prices were high, and what you did when the crash came and what you're doing now?
Yep, we certainly were. I think we can say this without the wisdom of hindsight, that we were well aware that it would be likely a bond market disaster that triggers an equity market correction or a bear. And that's because the yields on global bonds had just become ridiculously low. And it was only a matter of time until inflation started percolating and really hurting the real return on those bonds. And affecting the equity valuations. I mean, people always talk about COVID, but if we go back to the Trump administration, there were already inflationary things happening that have percolated through over the 5 years, since that midterm Trump election phase in 2018. Things like cutting down labor mobility so you don't get migrant workers, putting tariffs on goods. That was all building up a baseline inflation risk. And yet all that time, bonds were rallying and yields were getting lower and lower, assisted by the central banks, but also assisted by fund managers buying bonds because they didn't want to fight the central banks. So you got kind of the perfect time bomb in some assets by the end of last year. We thought that there was no reason really to seek the traditional safety that bonds provide to any significant degree in portfolios. We didn't think they would provide the safety this time around because the sequencing was different. You didn't get equity crash people buying bonds because equities are crashing. Rather, you got a bond crash and then people selling equities and bonds at the same time, which is what we've seen for the last 6 months.
Exactly, yeah. That's sort of a fairly unique scenario, and I guess it makes you question the sort of traditional portfolio construction made up of bonds and equities. It's supposed to be going in opposite directions, but this time around they've both gone together, and that's why we've seen some like conservative KiwiSaver funds do very poorly, and they're supposed to be very defensive.
There's the great economic law of unintended consequences, and that's almost a law of human history. After the GFC, it became an article of faith with regulators and even with private sector players that there should always be a certain number of bonds or proportion of bonds in portfolios, because bonds had done well through that crash. That means that people are forced to buy bonds, and maybe to a level with which they may not be comfortable. But portfolio managers are forced around the world to hold a certain proportion in bonds. Insurance companies, likewise, are forced to do so. Now, when you concentrate or regulate people into a certain asset class, you get over-concentration risk. And I think what we're seeing now is the unwinding of over-concentration risk. People are now saying, well, that didn't do the defensive thing that the last crisis taught us to expect it to do. Where is my diversification benefit going to come from? And they're scrambling into the sectors that actually have shown some diversification merit. The funny thing is with oil and energy and all those sort of stocks that have held up in this year, 2 years ago, you couldn't get an investor to touch those stocks. Oil had been a perennial underperformer. The energy sector had lagged absolutely everything. I remember when COVID broke, the futures price of oil was negative. It was below zero.
Yes, I recall.
You know, and no one would have been saying at that point energy is going to be the star sector in the next 2 years. Rather, they were ditching it from portfolios. I'm not saying now that I would recommend it. I wouldn't recommend it personally because we have a sustainability focus and we don't go for fossil fuels in our own portfolios. But the people who have excluded that on the basis of the fact that it performed badly are now missing out on its diversification benefits in a time of shortage.
Yeah, interesting. Okay, I think we should probably go to listener questions fairly soon. But before I do, I want you to cast your mind back to 1997 when you experienced your first bear market, presumably as a young finance professional. How did it feel at the time? What was like? What did it feel like the world was ending? What was the feeling when you had your first bear market?
I think you get worried about knock-on effects and snowball effects and, sort of hidden risks that are not on the surface. That was actually, funnily enough, also a debt-induced bear because it came from over-exposed or over-indebted Southeast Asian economies, and emerging economies in Russia was a classic example too. You just want to know that people haven't taken undisclosed exposures to very risky assets, and you just never know when the next mine is going to hit the ship. And it's happened not just back in 97. I remember my job in Switzerland. I got it the latter part of 2006, and then of course 2007 you started seeing stories like Northern Rock in the UK going bust. The Icelandic banks started leaking, and you thought something's coming here, but how big is it going to get? Mm-hmm. So yeah, what as a financial professional you worry about at this point is that there are, I think Warren Buffett has always said, people are swimming naked and the tide goes out and you see who's swimming naked. There may be a phase ahead where we start to see who's been swimming naked in the last 10 years.
Right, yeah, because you do see a few of those charts where you have extremely, like an innovation ETF, for example, which has gone all the way up and all the way down and met some boring assets at the same point as things have come back to life. So I think that's been really interesting to watch, and it shows how important it is not to give in to that feeling of FOMO when you see an asset going up and up. You want to buy it, but maybe it's just doing an arc back to where your more boring, safe, well-chosen asset is headed anyway.
Yeah. I mean, there's always a narrative or a story attached to an investment proposition, and if it's being pushed globally, you can bet that narrative is going to be amplified right through social media, through every possible channel. But you've still got to check it out for yourself. Don't just believe the hype, because the hype is being engineered by someone who's well positioned already in that asset. And you can see that across any asset in the world.
Yeah. All right, cool. Well, we've got lots of questions, so I might jump over and start feeding you those listener questions.
Thanks, Dave.
The first is from Alice, who says, what would you say to an investor who is experiencing their first bear market?
Well, I'd say, Alice, it probably won't be your last, but not to despair, because bear markets are a phenomenon of international capital markets. They can be very stressful. And especially if you see your wealth being drawn down. But they're also presenting value. And do remember, if there was a permanent bull market, it would be very difficult to actually realize long-term value because you'd never get a cheap asset. You'd never see something that was selling below the valuation that it was going to win out in the long run. And if you did see it, institutions or very, very well provisioned traders in New York or wherever would have got there first. So bear markets, they create opportunities because everything gets thrown out with the bathwater. Things that are good assets get cheap during bear markets. And I think that the advice is sit tight, but look for value where it comes up. Because some assets are going to be at, I've seen talk about certain assets being at generational buying opportunity levels now because the sentiment is so poor. If you can identify those and you've got your investment time horizon in mind, that's the crucial thing. What is your investing time horizon? Is it a month? Is it 10 years? Only you know that as an investor. If you've got a longer time horizon, you may wish to start putting in some of those cheap assets now.
Yeah. That time horizon is super important. It's sort of something might be quite high risk in a 6 month, 1 year timeline, but on a 10-year timeline, it might be very low risk.
Absolutely. Yeah.
Okay, cool. Next question. Someone says SALT funds offers a range of different funds. Does a bear market impact some of those funds more than others?
It does, for good and ill. I mean, without wanting to kind of talk the book as they say in the language of the trade, there is a SALT long short fund that can take short positions. Not every fund manager offers long short. That fund is obviously positively impacted because when you short the market, you profit from a falling stock price. And if you think that a particular security is very overvalued, you can take a short position in it. That's one fund that's done very well. Also, an uncorrelated fund like our carbon fund, that's been a great thing because it doesn't link up with other financial assets. It behaves according to the global agenda to reduce carbon emissions. And as we, as New Zealand, commit more and more to CO2 footprint reduction, that holds its value and it diversifies shocks in other sectors. In the funds that we've got that are more conventionally positioned, like I said earlier, we are a quality-based house and a valuation-based house and always have been. And I think we're seeing quality and valuation rewarded now to an extent that we hadn't seen in the years up until 2020.
Yeah, okay. Another question. What advice would you have for an older person nearing retirement who is experiencing this bear market? Perhaps it is their last as an investor.
If their portfolio is, it depends. I mean, if they've been well advised, their portfolio, as you approach retirement, should be focusing more on income than on capital growth. And an advisor will have put together some income, hopefully decent yielding assets. I think the thing to remember, when bond yields rise, that does actually increase the income that's available from those bonds. So if there's a bond portfolio, yes, it's probably taken a capital mark down, it's gone down in value, but as they reinvest the dividends or reinvest maturing bonds in that portfolio, they're doing so at a higher yield. Because savers have been really squeezed, not just since 2020, but for the previous 6 or 7 years. Their income's just been squeezed down as part of the cost of keeping the global economy afloat through difficult phases. So yeah, as you approach retirement, look at the sources of income in the portfolio, but also keep an element in the portfolio able to participate in the rebound, because the rebound will come. You can't put a calendar date on that, but it will come, and don't squeeze the portfolio out of any opportunity of participating in that.
Yeah, you're right to say that the bull market's been awesome for investors, but it's not been awesome for those who are trying to live off their portfolio or trying to save. It's actually been with interest rates so low, it's been a very hard time to save money or live off your portfolio.
It really has, to the extent that some income funds have moved into the terrain of using capital gains as a form of income. And as long as they're open about that, there's no necessary problem. We don't do that. But if the investor knows that some of their capital growth is being recycled out to them as income, that can actually work for some investors.
And right now inflation is so high that a lot of yields are negative. But when inflation comes down, there's going to be a reasonable yield even on a term deposit, which is sort of an exciting thing. First time I'm seeing it in my life.
Something above 4%, 5%, but you've got to go out to 4 or 5 years to receive that for now.
Tricky. Someone says, how could an average investor gain exposure in their portfolios to some of the recession-proof assets you've mentioned, such as infrastructure assets? How could they go about making sure their portfolio has some of those assets in there? I don't know, you can't recommend assets, but...
No, it's an excellent question, though. I mean, I think the thing to say is if you're too indexed, if you're too much in a passive sort of, you won't get much exposure just because they're not big parts of the market by market cap. Real estate is no more than 3% of the world index. It's less than that of the US index. Infrastructure is even smaller. So you do have to go to a specialized fund manager that offers infrastructure and global real estate specifically. and then you'll get a decent
Yeah.
watch of it.
So you could seek out a fund or an ETF that had infrastructure or real estate in the name, and
Yeah.
presumably that's how you could add exposure.
Yeah, yep. You can search on a variety of the tools or the platforms that New Zealand offers, for local investors. And if you just use the word infrastructure in the search term, a number of funds will come up and fund managers will come up with that.
A question here says, without giving advice, is it prudent in a bear market to invest more in exchange-traded funds rather than in individual companies? I guess, is that different in a bear market than in a bull market? ETFs versus individual companies, does that change the balance?
It depends on your ETF strategy. If the ETF has got a theme to it or it's got a sector to it, it's fine possibly. If you wanted to get your healthcare, global healthcare, there are plenty of global healthcare ETFs you could choose from. And that's an efficient tool to get in there. It's neither better nor worse, really. It just depends on whether you're using the ETF as a tool to fine-tune your portfolio, or if you're wanting it to juice up the returns on the portfolio. Because if you're wanting that, it's probably better to take a more concentrated list of securities, and you get more concentration in managed funds than you do in ETFs. Mm-hmm. ETFs tend to try and hold a whole sector, and that doesn't allow them to concentrate on parts of that sector.
Yeah. I've heard it say, diversification limits risk, concentration creates risk, but if it pays off, it creates more wealth. It's
that's absolutely right. Yeah.
It's an interesting one. So you kind of sometimes want to find a balance between being over diversified, and you might as well just be in an index fund or.
Core satellite is a great approach where you have a larger, you think of a planet and its moon. The planet is the core, and that just is efficient and builds value over time, but it's very, very diversified. The satellite is something you really believe in, and it will be volatile, but it's got the capacity to add a lot of value at different phases of the cycle.
Mm-hmm. Here's a question about bonds, which you talked about earlier. Bond valuations have gone through the floor. They're supposed to balance out equity risk. Alan asks, it hasn't worked, has it? And I guess inherent in that question is, will it work again, or is that a thing of the past? Are we thinking about bonds and asset allocation differently now?
Yes, we are. I think you have to say that we are. I think we had a 40-year bull market in bonds, so a downtrend in interest rates. And so every year, a bond not only gave you back the coupon on the bond, but it would give you capital gains along the way. Yeah. And so you got really artificially high returns from the bond part of portfolios. And that meant that a balanced portfolio got a solid return from equities and a solid return from bonds. And if you look over history, the statistical evidence you need to say something with any confidence, you might expect 8% from a balanced portfolio long run. We were getting, or not we, but the entire market was getting 14, 15, 16% from balanced funds for several years because they're experiencing gains in bonds and equities. So now there's almost mathematically no way that bonds can deliver those returns again until you've gone through a full cycle of the rates going right up, credit and duration risk coming back into the yield, and then seeing a phase where it tops out, the yields top out, you get a proper pricing of those risks and inflation risk, and then you get a downtrend again. So not probably for the next 4 or 5 years would you see bonds offering anything like the level they did in the last decade.
Yeah. So there's likely going to be less allocation to them as well.
Yeah. There's a certain amount of rearview mirror driving that goes on in all investment management, and people say, "Oh God, they just ruined my return," and they'll downweight them. I think actually, in a way, that's legitimate this time around.
Okay.
Because you're still taking risk of underperforming inflation. Until there are really signs that inflation is going below the bond yield, I think it's harmless to walk away from the bond portfolio, even, and I hate to say this as a fund manager, but even in favor of cash, and just keep the money in cash until you're convinced that the worst is over.
Yeah. Cash and shares. Yeah. Here's a really interesting question. From a New Zealand investment perspective, Sharesies offers a lot of international shares. You can buy in the ASX, you can buy in the US, and you sort of manage the global funds at SALT. Yes. There's someone asking here about currency risk. NZD, USD, FX rate down 12%. since late last year. How should a New Zealand-based investor approach investing in US stocks, taking the FX rate into account? How big of a risk is that? How do you think about exchange rate risks when investing in something like Apple overseas?
It's a really, really good question. I'm glad someone asked it, so thank you. Because it's very different between the type of fund manager you are. If you're a KiwiSaver provider, you're looking at maybe 20-year models. You're looking out 20 years. Now, over 20 years, it's worth hedging some foreign exchange risk.
Okay.
And so you'll see global shares portfolios that have got hedging on them. They might be half hedged, 50%. It may even be higher. Now, that hedging is good because it protects you against the Kiwi dollar rising and eroding the returns from the offshore markets. However, when offshore markets fall and Kiwi dollar falls too, you're protected on the other side because the Kiwi dollar is then, it's actually its own drop means the damage you've got from the US dollar securities isn't so severe. And as the questioner asked, if you've seen a 10% fall in the Kiwi dollar this year, if the US market had stayed steady, then you would have got a positive 10% return off the US market because the US dollar is buying more Kiwi dollars when you repatriate the value of the securities. So getting back to what we do, because we're not on the KiwiSaver sort of scale, we don't hedge our global shares. We treat the New Zealand dollar exchange rate as a natural hedge. And we are confident that during the periods of the worst volatility, the Kiwi dollar falls and it actually offsets some of the negative returns from the global shares. It's exactly what we've seen this year.
Yeah, interesting. So what you're saying there is if you hold a foreign asset and its price goes down, probably the New Zealand dollar goes down as well because investors are risk averse and that effect is actually lessened.
Yeah, absolutely. Yep. This is why, bad as it is, the returns that New Zealand investors are seeing from the unhedged assets are a lot better than some Northern Hemisphere investors are seeing because they don't have that benefit of their currency dropping.
That doesn't feel intuitive to me because it feels like if you're thinking about buying US stocks, I guess New Zealand dollar going down, you can now buy less US stocks, but you can buy more stuff in New Zealand where you live, so your return is better.
Yeah, going forward, you'll be spending more Kiwi dollars to buy the same US dollars, but you've had the previous period where the US dollar value of your portfolio was worth more as Kiwi fell off the cliff. Yeah,
interesting. All right, and last question is: overseas markets like US allow investors to short shares, buy put options to insure or hedge their portfolios. Those tools are not available in New Zealand. Why not?
You can access them. You can short. As I was saying earlier, there is a short product in the Salt Suite. The options markets are interesting because, yes, you can insure your portfolio, but it comes at a price. And those contracts are sold through brokerages here who make sure that they make a good profit out of those hedge contracts. And often, unfortunately, when you most need them, they become the most expensive. That's just the nature of the pricing mechanism. And investment banks are out there writing put options, which ultimately investors may find actually diluted their overall return rather than enhanced it.
Right. Not always as great as it sounds. All right. Well, Greg, that's sort of all the time we have. Thank you so much for taking the time to chat with us. Any final words of wisdom for us?
I think really now where we are now, a lot of the damage has been done. Don't wake up today and say, oh my God, I've got to adjust my portfolio. Rather say the things I'm interested in are cheaper than they were before. So go to Sharesies, look down the list of securities and identify things you want to hold and see where you think the value is. Because there's been a fire sale in certain sectors and there's certainly some good long-term value there.
Damage is mostly done. Okay, that's a good parting message as we're going to get, I think.
Natural optimism.
Cool. All right. Well, thanks for tuning in. Big thanks to Greg for joining us. We really appreciate your time and insights.
Thank you very much, Dan. Thanks for the opportunity.
You're welcome. Next week on Shared Lunch, we're going to be talking to Lyndall York, who's the CFO of Fisher & Paykel Healthcare. A link to register for that discussion will be in the chat right now. But until next week on Shared Lunch, enjoy the rest of your week and stay safe.